So here we go. Thank you very much indeed for coming to listen to us, and thank you, Boolers, very much for inviting Victoria and I to do a little presentation for you. So we'll kick off. We'll be pretty punchy, but there'll be plenty of time for Q&A later on. So Lion Trust is quite an established business. We started in 1995. The company was listed in 1999. I joined them in 1997, so I've been there a very long time now. We're headquartered in London. We have 7 investment teams. We run about 28 billion, and our team runs about 7 billion of that. And we've been running money for a very long time, obviously, at Lion Trust. I started the small cap fund in 1998. We do 4 funds. The eldest is the small cap fund, but we also now have a micro cap fund, so that's investing in things which are pretty small in the market, 150 million market cap downwards. We have the smaller companies fund, then we have the special sits fund, which is our biggest fund, and that invests right across the market, so large cap, mid cap and small cap. And then we have our UK growth fund, which has a bit in small cap, but is predominantly what we would call our large cap vehicle. So that's if you want to be into bigger companies, that's where you would want to travel. So small caps are a fantastic, absolutely brilliant area to invest in. The power of small caps is really demonstrated here. So if you look at the green graph, that is the bottom 2% of the market. So if you put £1 in all those years ago, that would be now worth £22,000. So small caps can be very, very powerful. And the area where we fish is in that green bit and also a bit in the bronze bit as well. So we're kind of in an area of the market where the long-term compounding can be very, very exciting. These are entrepreneurial businesses. They're fast-growing businesses. And there's lots of valuation opportunity, particularly at the moment after what has been quite a tough couple of years. So the importance here is to really demonstrate the importance of kind of hanging in there with small companies. You've just seen that they can compound, they can deliver fantastic returns for you, but there are also some years where there's some very sharp drawdowns, some really tricky years. I can remember, for example, the old tough year of 2008 was a time, obviously, of the financial crisis, and smaller companies' share prices got hit very hard, despite the fact that there had no retail banks in smaller companies. But generally, it was kind of a risk-off environment, and people were worried about the stock market in general. But then you see the very strong bounce back in 2009 and for years after that. And then we've more recently had a number of those sort of drawdown years. But that's what happens in smaller companies. You're going to get some drawdowns, but you're going to get some absolutely super years too. And people tend to focus on the drawdown years and kind of worry about them and then forget the good years. But the long-term compounding, the good years are very good indeed. So that's the performance of the fund since 1998, and I believe that we've had a relationship with Boolers now for over 10 years, in fact 10 years and 2 days. So a number of you will be invested in the fund, so thank you for your support over those years. This really does show the kind of long-term compounding ability of the fund of smaller companies. So it's a record we're proud of, and a record that the team have really worked hard to produce.
It's great to see so many faces who are interested in investment and want to hear more about it. And we're delighted to be here today presenting to you. What I'm going to tell you about first is how we select the smaller companies that go into the fund. There are 60 companies within the fund today, and we follow an investment process that traces its origins all the way back to when Anthony first joined Lion Trust 26 years ago. At its heart, I think the thing that I'd like to get across to you is that we operate really a very simple, common sense approach to selecting our businesses. We're looking for great business models, resilient companies that can then go on and exploit that 8th wonder of the world that Anthony's referenced a few times, the power of compounding. So how do we do it? Well, we look for companies that possess significant strengths in intangible assets. So assets that you can't necessarily see or touch or feel, but are nonetheless extremely powerful when it comes to conferring upon those companies an enduring competitive advantage. So there are lots and lots of different intangible assets that companies could possess that have been written about in academic literature for decades. We alight upon 3 of them as effectively a gateway into our fund. So unless a company possesses at least one of these 3 intangible assets, we won't select it for inclusion in the fund. And those three are the three that you see in the coloured circles up at the top left: a strength in intellectual property, a strong distribution network, or high levels of repeat business, which for us means contracted recurring income, resilient turnover that you can predict year in, year out. Underneath that, we're also looking for a number of other intangible asset strengths. So we'll be taking account of a company's strengths in, for example, strong customer relationships, brands, franchise businesses, the culture of the underlying business. But the main message is that if it hasn't got one of these three key intangibles, we won't include it in the fund. And where does that lead us in the market with regard to our sector exposure? Well, it probably comes as no surprise that with intellectual property in mind, we might find ourselves in businesses in the technology sector, in pharmaceuticals, for example, industrial businesses, or profitable media and healthcare companies. In terms of our distribution focus, in this fund, we get less of that sort of wide global distribution network strength with these companies that have spent decades building that up all over the world. There are a few who possess it, and there are a few certainly who have national distribution physical strength. But what we also see a lot of here is a more modern type of distribution network, an embedded, data-driven distribution advantage where a company might be manipulating or creating critical data on behalf of its customers, and that's obviously of ever-increasing importance in the digital age. And then recurring income, that might lead us again into software companies, which increasingly are selling on a subscription, cloud-based model, or it might lead us into fee-based financial services companies. Boolers, for example, would be a company that perhaps if it were listed in the stock market, we might consider for inclusion in the fund. So that's stage one of our process, looking for those intangible asset strengths. We then ally that in the second stage of the process with a bit of a test. So what we'll do is look at the financial returns of the business to ensure that we're getting you into companies that have high and stable returns on capital. And what does that mean? It means that they can then reinvest those excess returns back into the business to again drive that virtuous circle of compounding and growth that Anthony's already described. We should also mention that within our process for smaller companies, we explicitly seek to align ourselves with entrepreneurial founder managers or owner managers of businesses. So we have a rule within our fund, within the fund that you're invested in, that we won't invest unless the management team has at least 3% of the business held by themselves. And let's take a look at what that might mean. So at the moment, the average market capitalisation, the average size of the business that the fund is invested in, is almost £500 million. And on average, our management teams have a lot more than that 3%. They actually have over 20% of the business on average. So what does that mean? It means that on average, they've got over £100 million of their own money at stake in these companies. And that is a very powerful motivator. Not only is it a powerful incentivization tool for these management teams, we align ourselves with them via that ownership requirement, but also perhaps an underappreciated strength there is that it makes them more conservative with how they manage their businesses. They think like owners of businesses, something that I'm sure is familiar to many of you who might well run your own businesses. So we find that a really valuable attribute, that conservatism, when it comes to delivering those long-term returns. I won't go through a lot of this, but just to pull out a few key stats. Effectively, as we've already referenced, smaller companies often see just isolated periods of very sharp drawdown. And part of that is because people perceive the smaller the company is, the more risky it is. Now that may well be true from a stock market perspective in the very short term. They can exhibit periods, as we've seen, of high volatility. But what we're focusing on is the underlying business strength. And I think it is quite notable that the type of company we invest in the fund is actually very resilient despite their small size. So I'll pick out a few of the stats here. 2/3 of the companies in the blue at the bottom have net cash on the balance sheet rather than net debt, obviously becoming quite an interesting income generating asset in its own right as rates have risen over the last year or so. Also, almost 90% of them pay a dividend. We don't explicitly look for companies that pay a dividend. We'd like it if they do, but we're not specifically targeting that. But we think it's a great sort of point of evidence to show that these are companies that are willing to submit themselves to the discipline of paying out a dividend to their investors year in and year out. Another point I should pull out is the overseas sales stat, which hopefully you can see just behind my head here. Over half of the underlying sales of our companies come from overseas, not from the UK. So I think, again, people are concerned potentially that for UK smaller companies, they might be overly exposed to the domestic economy. But actually, quite a lot of the sales of our companies are coming from a diverse collection of countries overseas. So we think that's a really important stat to pull out as well. Anthony referenced earlier that there is a real valuation opportunity in the UK market and in smaller companies in particular at the moment. So we thought we might give you just a few stats to illustrate the scale of that opportunity. What you're looking at here in the graph is coming from a data provider that we value very highly called Quest. That company provides us with analysis of cash flow returns on capital for our process. And Quest effectively create a valuation model for every company in their universe, which is based on future cash flows of those businesses. And the graph here is comparing that intrinsic value of those companies, if you like, for the UK market in the green, to the total market capitalisation of the UK in black. And as you can see, the lines track each other pretty closely, so the market cap tracks the intrinsic value pretty closely, all the way up till 2021, at which point the jaws of value open, as they say. So there looks to be a really significant valuation opportunity, an upside opportunity at the moment in UK equities. They think that the gap between intrinsic value and where we're trading at the moment in the UK is about 28%. And for those who've heard a lot about the power of the US stock market, I think it is noteworthy that on the top right there, the US market currently is sitting 40% overly expensive on the same metric. If we look at our fund, again, what we're looking at here, I'll just explain it very quickly, is the average backward-looking, what we call a price-to-earnings ratio, or PE, of the fund. And effectively, what that ratio is telling us is how many years of a company's earnings are we paying the price we're paying today. So it's a useful way of looking at valuation for investors in the stock market like we are. The long run average, you can see in the grey there, is almost 19 times, and the fund is currently sitting on about 15.5 times on the same metric. So it looks like a decent upside opportunity just with a bit of mean reversion there. And I think it's also noteworthy that, as you can very clearly see, that long run average includes a period of sharp decline in the global financial crisis, which I'm sure many of you will remember as being a long, protracted period of economic hardship. I'm going to hand over to Anthony now, who's going to talk a little bit about this valuation persists, but what might change it? What reasons do we have to be optimistic that the UK will come back and outperform?
One of them is clearly M&A in the market, and this shows the names of the companies across all of our funds that have been bid for in the last couple of years. So a lot of those are small companies. Probably the reason why it's generally been small companies is that while we've had the kind of higher interest rates, it's probably been more difficult for private equity to price deals, and it's easier just to get the borrow for the deals for smaller companies. But a lot of smaller companies there have been taken over. So what you're going to see probably is more takeover activity. What that does is tend to underpin share prices, but also brings money back into funds like ours. So in the last quarter of last year, you will have seen the kind of pickup in performance of the market and smaller company funds in particular. And there are a number of companies that were where the cash came back in that last quarter. Well over £1 billion of money came back in from the sale of those businesses into the market in general, and that would have helped lift prices a bit in the last quarter. So M&A is going to be one clear catalyst. Another one is potentially policy activity. So I think there's a general realisation now from politicians on both sides of the fence that something needs to be done. Financial services is a very important part of the UK economy. It seems to have been somewhat neglected in policy terms. We need to get the stock market humming again. We need to get more IPOs coming to the market. We need to really get behind the importance of a stock market in a successful UK economy. So I think the politicians are alive to that, and we've certainly been trying to do our bit in lobbying, not only as a sort of wider fund management community, but also our team. And Natalie on our team has been fantastic at getting us sort of introductions into being able to do a bit of lobbying. So we've been talking to Jeremy Hunt's special advisors, civil servant types, and they were pretty receptive. And then Natalie and I, a few weeks ago, went into Downing Street to see Rishi's political advisors, and again, they were pretty receptive. I wouldn't say that things are oven ready. There is a sense in which they are receptive, they're thinking about it, they were asking questions, but I don't sense that the things are ready to roll, but maybe by March something might be done. So what could be done? One thing is potentially a British ISA, and we would be supportive of that. So basically, instead of you putting your money into maybe overseas shares, you can buy Apple, you can buy Tesla into your ISA, it would be much more, here's your £20,000, but you've got to be backing Britain when you do that. And to us that seems right, in the sense that if you're getting a tax break to invest in companies, well, it'd be good to see people investing back into the UK economy, because that's going to in the long term going to drive the wealth of our nation. The other angle, of course, is pension funds. Pension funds have been reducing over the years the amount they put into UK equities. I think the MP's pension fund has absolutely nothing hardly in UK equities at all. So they're leading by a bad example. No surprise there perhaps, but we need to get pension funds back into investing into UK equities and UK firms. So hopefully there might be something on policy in terms of getting people the pension funds back into the UK equities. When I started work in 1990, I was with Schroders for 7 years. We were winning pension fund mandates, week after week, and lots of equities were being owned by UK pension funds. That isn't the case today, which is very sad. Another catalyst is just following the money. Here what we see is the kind of ratio of directors' buys to directors' sells. Now the amount is often more in sells than buys. So what this though is showing the number of trades. So this is like a sort of activity ratio. And what you've seen recently is the activity of buys, the number of buys that directors are doing has increased a lot. So they've got greater confidence in the value of their companies and are putting their money where their mouth is. What we're trying to show here is the impact of our type of fund on the UK economy. We own 60 companies in the UK. There's 70,000 people employed by the companies that we own in the fund. 300 million of tax is generated by our companies. So, we think it's really important, the power of the stock market and supporting businesses out there. So that's the kind of high-level picture of what's happening in our fund.
So we wanted to give you a little bit of a local flavour to the presentation at the end today. Obviously, for many of you, what we've just described will hopefully make sense, but will sound probably quite theoretical. And we thought it would be really helpful to bring that to life via a look at a few of the companies that are held in the fund, which are based not very far away from where we are today. So what we've done on the slide, and it would look better obviously if we could see those blobs, is split up the companies that we own into each region of the UK. And if we just zoom in on the Midlands for a second, you can see that we hold 5 of our 60 companies in the local area where we are today, employing over 4,700 people within those 5 companies, generating 700 million of revenue and 16 million of tax straight to the exchequer. So obviously valuable if we think about the levelling up agenda of the government and trying to generate that and get things going. I'm going to focus in on just 2 companies. The first that I'm going to talk about today is called Microlise. Now Microlise is actually based less than 20 miles north of here in Eastwood in Nottingham. Many of you might know that. And I thought I'd tell you a little bit about what it does and why we're excited about it. So Microlise is a software company that's providing its software to the managers or the operators of fleets of vehicles, fleets of commercial vehicles. It specialises in the biggest fleets, so 250 vans or vehicles and above. Its sweet spot is really even bigger than that, so 500 vehicles and above. And from our process point of view, we see deep intellectual property in the software itself, but also that embedded, data-driven distribution strength that I talked about. When a company takes Microlize's software to manage how its fleet of vehicles is operating, it will be managing everything from optimizing the routes that the drivers are taking, all the way through to how are those drivers driving? Are they driving safely and efficiently? So it becomes very, very sticky within those end customers, and therefore the churn, or the rate at which their customers leave them, is extremely low, less than 1%. When we think about that entrepreneurial owner or founder manager angle, its CEO, whose name is Nadeem Raza, who set the business up some 40 odd years ago, still owns over half of the company. And when it IPO'd on the stock market in 2021, he didn't sell a single share, which we really, really like to see. It means that he's got very high conviction in his own business. And if I just show you here, you can see on the top right some of the big logos of the company, of the customers that the company boasts. Obviously, many of those are household names. They've got a particular specialism or a particular penetration of the UK supermarket sector. So you can see many of the names there, Tesco, Asda, etc., will be obviously familiar to you, even if Microlize themselves may not be. Clearly, in terms of timing on the bottom right, 2021 marked the peak, unfortunately, in the stock market in the very short term for them. But hopefully, the eagle-eyed amongst you might notice that right at the end of the graph there, you can see a very sharp jump up in the share price, taking us back to the 0%, and then hopefully catalysing a rise above that again in the short and medium term. That's because the company very recently announced upgrades to its profit forecasts for the current year. So doing well despite the slightly tricky, slightly sticky economic environment. And then the other one I was going to talk about today is FW Thorpe, which is the other way. That is about 55 miles southwest of where we sit today, at the East Midlands Hilton. And FW Thorpe is a very, very different business to Microlize. So that is a business that provides industrial lighting solutions, specialising in technically complex, high reliability, high quality lighting systems for its customers. So some of the examples of its recent project work include lighting up Big Ben as part of its recent renovation. It's also got numerous stories of how it's lit up things like the Bell Common Tunnel on the M25, if any of you have ever been stuck in there like I have when I go to see my sister. Or indeed lighting in factories, which may not sound very glamorous, but of course it's absolutely critical to keeping that factory going day in, day out. And for the customer there, that's absolutely critical in terms of their own profit generation. So they see it as being very important to get that very reliable, and they're willing to pay a premium price to do so. FW Thorpe was originally founded in 1936, so it's a very old business. It was founded by the eponymous Frederick William Thorpe, and his grandsons and a great-grandson still work in the business today. So it's got that lovely management ownership angle, family-owned angle. I think they hold over 20% of the equity between them, yes, 23%. So again, you've got that really nice entrepreneurial drive sort of pervading the business. And I think one thing that's really, really notable about that company, because although clearly, we have strong conviction in it, that sounds like it might be the kind of company that over the economic cycle might suffer a little bit from cyclicality. Companies might well push back, delay decisions on renewing their lighting. So it might well be one that you might think about as having that bit of cyclicality or fluctuation in returns. And in fact, over the years, the opposite has actually been true. It's been a remarkably consistent generator of returns, as you can see on the top right graph there. And I think we put on the slide a few of the stats about the compound annual growth rate, so an average growth rate over 5, 10 and 15 years on the black there. So 10% average growth of that business over the 5 years that preceded this date. So obviously that was not a period that was without its challenges, both on the upside and the downside.
We absolutely love doing what we do. We're a team of 6. We a tight team. We're quite entrepreneurial. We love visiting our companies. We love unearthing this intellectual capital that we think is so powerful in barriers to competition. Indeed, when you rip apart lots of businesses, actually when you find and think about what makes them successful, it is often things like the distribution networks, their intellectual property, their brands, their culture, their format skills, repeatable format skills. So that focus on intellectual capital we think is really valuable. That focus on returns, the cash flow returns on invested capital, we think is a powerful validation It helps us make sure we're getting you into businesses that are strong value creators, and then they can hopefully do that compounding for us. So the style is kind of low turnover as well. The biggest reason why we sell a business is that they get acquired, because quite often these kind of niche champions will get acquired by other players who just want to buy the business because they can't replicate it easily themselves. So that's the long-term story of the fund. Thank you for your support. We really do appreciate people who've been with us and invested for a long period of time. It's so nice actually to present to the actual investors. Quite often we're talking to the wealth management companies, but actually to meet people who are the underlying holders is really nice. So thank you all very much for coming, and thank you for your support.
Good morning, everybody. Thank you for joining us today and supporting this event. As John mentioned, my presentation is the first of the two Boolers presentations. It's going to take more of a retrospective look at financial markets over recent times and to try and make sense of them, really. So three real sections of the presentation. The main part of it is looking at where markets have come from and where it leaves us. Gavin's presentation would be more forward-looking and taking it from there. In doing so, I'll also look at how we reacted to the return of inflation, which has been really the key theme of the last couple of years, and if time permitting, allude to the path to recovery as I see it. Now, in this presentation, I'm deliberately going to go back beyond 2023, and that really is because I think I see 2023 as being more a sequel to 2022, which for me was the main event when we saw inflation return with a vengeance. And if we talk about 2023 without bringing 2022 into it, it's a bit like watching Godfather 3 without having watched the earlier movies. You really need to bear in mind 2022 for the full context of why 2023 performed as it did. So I'm going to start with a question, which is where we are today as a result of yesterday's priorities is a rhetorical question, because I believe the answer is yes. My belief is that big shifts in financial markets really are rooted in events or reactions to events that took place one or even several years earlier. So, for example, the return of populism towards the end of the last decade had much to do, in my view, with the global financial crisis and decisions that were made at that time. In a similar sense, just as 2023 was a sequel to 2022, I believe that 2020 was a prequel to both of them, because that saw COVID and really the economic stimulus or overstimulus that gave rise to the inflation that we saw in 2022. So these things are all linked and they're all relevant. So 2023, how did we get there? So I'm going to take us back in time a little, and in doing so, to keep things simple, I'm going to focus on the US and UK equity or share markets, and I'm also going to look at, I'm going to throw in UK government debt as a bit of a contrast as well. So for the UK, for illustrative purposes, I'm going to use the FTSE 100 index, which is the UK's 100 largest stocks, so the other end of the UK market from Liontrust UK smaller companies. I'm using that because it's more sort of old economy. The stocks that dominate that index are really your banks, oil, energy, fossil fuels, basic materials, industrials, pharmaceuticals. And for the US, I'm going to use the S&P 500 index, which is the other end of the scale. It's dominated by the Magnificent Seven, big tech, Amazon, Google, Microsoft, etc. So very different ends in terms of market sectors, so you'd expect very different performances. UK gilts or government debt, I'm putting that in there really because that's, for portfolio construction asset allocation purposes, that's our go-to sort of safe haven. So for when equity markets are under pressure, gilts are usually there to bail you out. Well, that's the plan anyway, so we'll see how that turned out. So I'm taking us all the way back to February 2020, when the COVID epidemic became a pandemic, so it went from being a China problem to an everybody's problem. Now, global stock markets fell from February 2020. So that was a period where it heralded half of the global economy shutting down, something that's never really happened before. Even if we include world wars, economies keep going, it's just their function changes. But we actually saw an artificial grinding to a halt for a lot of the global economy. Global supply chains collapsed, so everything from toilet paper to dominoes just became impossible to access for a period of time. But most alarmingly, we were told right at the beginning, around February time, that it would probably take about 10 years to formulate a vaccine to actually deal with COVID. And for me, that was probably the most alarming piece of news, because that meant that the new normal that we're settling into would probably not go away very soon. So how did stock markets react to all of this? Well, this is really just showing January to the end of March, and pretty much as you'd expect, stock markets didn't do very well at all. The FTSE 100 over a 6-week period from sort of mid-ish February to late March, it lost about a third of its value, which is really scary over a 6-week period. To put that in perspective, some indices actually lost the same or more over a 6-week period than they did over a period of about 11 months during the financial crisis. So a very scary time to be invested, not a pleasant time to be an investment manager. Gilts actually, they offered some relief, so you can see that gilts actually rose by about 7%. So that gave some floor to diversified portfolios. The more cautious investor you are, the more you can have exposure to gilts. But if you're an adventurous investor, you're going to be 90% plus invested in equities. So really a very uncomfortable time. Then from March 2020, and we're talking really pretty much for most of the rest of the year, lockdowns and infections peak. Really, this is where all the bad news actually happened. So February, we were looking forward to things getting worse, if that's the right term, but March onwards is when things got really bad. We saw some of the worst recessions we've seen, certainly in my lifetime. In the US, we saw the worst recession since the Great Depression. In the UK, the FTSE 100 and the UK stock market saw its worst recession in over 300 years. Interest rates fell to a level that we've not seen since the formation of the Bank of England, I think in the 1600s. So a lot of new territory for us in a very short period of time. We had an estimated output loss of $9 trillion over that period. That's a huge amount. So bearing in mind all of this bad news in this huge crescendo, how did markets react to that? Well, actually, probably not as you'd expected. For most of the rest of the year, markets actually went up. Why? Because everything's going wrong. Why did markets go up? Well, the reason for that is really that markets are forward-looking. So they're looking through all of this. They're looking through this really terrible bad news and everything looking very dark. They're looking through to the other side, to good news at the other end, because they want to be ahead of the curve. They don't want to wait until things have got better before they invest. And so we saw a period really for the rest of 2020 of what you'd see as good economic news, in that although the global economy was in partial shutdown, you saw extreme economic stimulus from governments and central banks to a level that we've just not seen before, and I'll come on to that. You know, the recessions themselves, they lasted for 2 quarters. They were the shortest on record. And most encouragingly for me, I think, was the fact that early on, you know, within a few weeks of the darkest point of the markets, we were told that vaccine trials should be up and running by September. So that was a big revision. And you can see in this chart, really the red line is the S&P 500. That ran away with things, but that's because of the tech focus, because tech wasn't really affected by things. Tech benefited. I'd never been on a Zoom meeting before lockdown. And so tech came to the forefront and saved us in many ways. We all went home at Boolers 23rd of March and worked from home. And it's ironic that that's the same date where the market troughed. That was the bottom of the market. And from there on, it just got better. The FTSE 100, it did rise, but it sort of bobbled around for a bit. And that's because it was more weighted in oil and fossil fuels. And if you remember, road traffic in the UK in those summer months was down 90%. So the fact that it was weighted in areas that were struggling, and in April 2020, you actually had oil futures trading negatively, which I don't remember that happening before. So the FTSE 100 was put under pressure mainly because of the stocks that dominate it. But even the FTSE 100 had a good period sort of towards the end of the year, around about November, where you had a real value rally. And that had much to do with the fact that stage 3 trials of the vaccine were completed, and there was a clear path to us getting back to work and to the economy picking up again. So markets not behaving as you'd expect, but that's because they're forward looking and they're expecting things other than what we were at the time. So we get to 2021. Lockdowns end, unless you're living in China. Global economic activity, it starts to pick up again. We're not quite at normal, but we're moving a long way in the right direction. If stock markets continue to rise because that's good news. But inflation also starts to rise at the back end of the year. Now, if we look at how markets did, and this is throughout 2021, it's pretty much good news. Government debt, pretty unimpressive, pretty boring, just moving within a defined range, but it's good news almost wherever you are for equities. There's certain styles of equities that outperformed in 2021. It's a dovetailing sort of year, but generally it's more of an everything rally for equities, particularly US, because again, tech continued to benefit, but the FTSE 100 did fine as well because it benefited from an increase in industrial production. So, more demand for oil, fossil fuels, mining stocks, etc., commodities. They all did very well. But that area began to overheat towards the end of the year. And you can see a slight pause, a slight bit of uncertainty right at the end of that chart. And that really has a lot to do with thoughts about where inflation was going to go. In the back half of 2021, the phrase that, this inflation that's coming in from the mid-year, that it's transitory. Transitory became a buzzword, and at the end of the year, it sort of died out. So in December 2021, UK led the way with central banks and started to raise interest rates. Up until that point, interest rates in the UK, we got a base rate of 0.1. Which we're just not used to. So it's not unusual to expect that to lift as soon as it's economically prudent to do so. Now, in response to that, and at the back end of the year, bond markets and US equity markets fall, but the US equity markets, nothing to do with UK interest rates. It's more to do with general unease about inflation. Is it transitory, or is it going to be more deep-rooted? And here we're looking at about a 3-month period from December onwards of 2021, where we're looking at the US equity market in red, really not having a good sort of end to 2021, start to 2022, because the very thing that made tech attractive, free money, that would disappear with interest rate rises. Tech stocks would suddenly look very, very expensive. So in January, you had the worst month for the Nasdaq in several years. It was really quite stark because people started to think these tech stocks all of a sudden they look very expensive, particularly if you expect inflation and interest rate rises. However, the FTSE 100 was doing fine because the very things that were driving inflation are the very things that dominate the market in terms of sector representation. So FTSE 100 did fine. Gilts, you will see, they fell along with US equities, and that's because they're badly hit. Interest rate rises are not good news for gilts, and I'll come on to that. So we get to February, Russia invades Ukraine. I personally didn't think that would happen. I thought that all of that military surrounding Ukraine was another bluff, just like it had been the previous June when he'd done it then, but it wasn't. He invaded Ukraine. Fortunately, we'd actually halved our emerging markets exposure the day before, but that was luck rather than good timing, I think. But what happens there? Well, Russia invades Ukraine, inflation mushrooms, and bonds and US equities continue to fall. Now, if we look the following month, it's compounded by the fact that US interest rates start to rise in March. So let's look at about a 6-7 month period, sort of from early on in the year, really taking us to September. It's bad news almost where you look. The only thing that's keeping the FTSE 100 going is really oil and energy, because as bad from a humanitarian point of view as the Russian invasion of Ukraine was and is, it's really when markets are affected, it's because of global trade, it's trading relationships. If that's at threat, that was the main thing that made markets fall when we had COVID. It's about global trade. And so here we have a situation where an old trading relationship between Russia and the West for primarily oil and gas, but other things, fertilizer, soft commodities. But if you take oil, for example, we'd been buying Russian oil since at least the fall of the Soviet Union, and Russian gas had been piped into Europe since, well, throughout the Cold War and Cuban Missile Crisis. It didn't stop, but all of a sudden it stops. Now, if you fracture that relationship and we have to source, Russia has to sell its oil elsewhere, we have to buy gas from elsewhere, and we have to do it at greater cost and from new partners, that's a short-term energy supply shock. So effectively what that did, we came into 2022 expecting inflation. We expected inflation, we expected interest rates to rise, but we expected inflation in the UK to probably peak at around about 7% and probably be dying down again, peak by the third quarter of 2022. All the Russian invasion of Ukraine did is just turn our expectations up to 11. So we had UK inflation up to 11% and persisting until the first quarter of last year. So really a very negative period. And you can see that gilts have been particularly hard hit during this period, because it's not so much the inflation, but it's the interest rate rises that you expect to combat inflation. As interest rates rise up, the fixed income that you receive from government debt and corporate bonds, that becomes less competitive. And so the only way that they can compete with rising interest rates is for the capital values to fall. And so 2022 was a bizarre year where equity markets were under pressure, but also the very go-to place that you go to, which was gilts, they were struggling even more. And so the gilt market underperformed many equity markets, including UK mid-cap equities, which is unusual, shall we say. So we get to September, Trussonomics begins. It's a relatively short area in British political history that is still notable, but we had basically bond and equity markets falling in response to the now legendary mini budget, where you had huge unfunded tax cuts and spending promises that the bond markets basically, that bankroll government spending to an extent, they just didn't like it. And so what we had is FTSE 100 fell a bit, but bearing in mind we still had inflationary pressures and the things driving inflation, it was a good place to be during that period, relatively speaking. But it wasn't very popular. It was a grim period, but happily that only lasted a month. So we get to October and the era of Trussonomic ends, and bond and equity markets, they actually rise. It'd be unfair to say that Liz Truss's departure actually gave way to a bull market in equities. That had more to do with general optimism that inflation had just about peaked in the US, and there was optimism that therefore the trajectory of interest rates would actually top out and start to fall. So it's basically when markets see that trajectory, that forward-looking, they see a positive outcome on the horizon. So we sort of finished the year. We finished 2022 with a degree of optimism, which takes us to 2023, a year I'd define as optimism versus setbacks, or 3 steps forward, 2 steps back. This is all on one slide, thankfully, but it was a busy year, even though from the market return at the end of it may not have felt like it. But we started the year positively enough with, we had the China COVID policy came to an end and they finally unlocked, and we had a lot of optimism around the big China reopening trade, big consumer domestic boom. China's a really important economy to the world. China's driven about 36% of global economic growth over the last 10 years. So China getting back off its knees and producing again, that's good for all of us. However, that gave way to disappointment early in the year as the inflation numbers started to come through the US and the UK. Inflation is what we call sticky. it's going down, or in our case, it wasn't going down, but it's basically not going in the direction that you want to. Either it's just not going in that direction, or it's not going in that direction as quickly as you'd like it to. So we had sticky inflation, but we also had sort of February, March, we had a US mini banking crisis with Silicon Valley Bank. A typical run on the bank, but untypically it happened over an extremely short period of time, causing panic among sort of regional US banks, which turned out to be a bit of a storm in a teacup, but it concerned markets for about a month. Then we actually get to the mid-year point, and we see a decoupling of the US and UK, where in the US it's all good news. There's very real evidence of falling inflation. We get to the third quarter and the interest rate hikes cease. And going into the summer, if you remember, we had a lot of hype around AI, which hadn't completely gone away, but it was sort of, well, it was very much present going into the mid-year point last year, and people were looking for ways to access AI. And so that was probably the thing we got asked the most about. Just as during lockdown, the thing we were asked most about was Bitcoin, and we've moved on from that slightly. But AI is a theme that's persistent. We've had exposure to AI for, I think, 3 years now. But on the other side of the coin, UK, our inflation was more sticky than US. So there are structural factors within the UK relating to labour market and other things that means our inflation has taken a little more effort in getting to come down. Then we go through the summer and the optimism in the US dissolves. Basically, you have big increase in the oil price, around 20% increase to the oil price, which that's inflationary, so it takes away confidence that could we see more rate rises? You also importantly had a credit rating downgrade for US Treasury debt. Now that's important because that determines the rate that the US is going to be paying on its debt in the market, and US borrowing continually heavily. We have very high government borrowing in the UK, the US even more so. So we then get to October and we have the Gaza situation, which was, again, very bad news for stock markets because immediately you have, it's not so much the oil price increase because oil had already been rising in price, it's the fear of it escalating into a wider conflict. And again, coming back to what does that mean for global trade? We've seen disruption to shipping in the Red Sea. That was one of the concerns. But also, would Iran get involved? And if Iran gets involved, you've got the Straits of Hormuz as well and oil transport. There's all sorts of things that can go wrong in the Middle East. So markets are always nervous when things happen in that region. Happily, we ended the year with what we call the everything rally, where markets took about 4 weeks to work out it's not going to escalate into a wider conflict. Now that's a moving thesis that can change very quickly, but for the time being, towards the end of 2023, markets decided no, this is relatively contained, and we then started to have, for the first time, having inflation disappointments for the whole year, where the figures were disappointing. We actually got good news in the space of 1 week in the US and the UK. Our inflation dropped below 4% to 3.9. So very good news week, and interest rates topped out in the UK as well. So everything went up at the same time, and the Fed pivot, that's basically the Federal Reserve in the United States actually talking about a pathway to interest rate cuts for the first time. So November, December was a very positive period for stock markets. We're glad it came along because without it, we would have probably been sitting level or slightly down for the calendar year. But as it was, portfolios were actually, they finished the year in positive territory. So the inflation bubble. I refer to 22-23 as being an inflation bubble. And that's simply because here's a chart of UK, US, European inflation going over more than the last couple of years. It's going over quite a few years. And you can see that at the start of the chart, in the response, the aftermath of the financial crisis, we had an uptick in inflation, UK inflation ticking higher because you had various other factors at play there, particularly with weaker pound, for example. But look at the back end of it. That's the inflation bubble right there. It's very distinct, and it's also relatively short-lived. So this chart really illustrates why I would say that we can't really talk about 2023 without talking about 2022. That dividing line is the dividing line between those 2 years. 2022 was the year of inflation going up, 2023 was it coming down. Why did inflation go up so much? Well, it's coming back to big market shifts being rooted in earlier events. So, COVID gave rise to a very big government and central bank response. This is a chart that I put in an investment commentary in June 2020 when we were still in the first lockdown, and it looked at the scale of government and central bank response expressed as a percentage of gross domestic product of each nation, and it looked at it over a period of 3 months compared to 12 years of measures designed to tackle the global financial crisis. Now, I'd been going to investment seminars for years after 2008 and being told consistently, we pull big financial levers there. If we have another financial crisis, we've got no more big levers to pull. Well, as you can see, the orange is the 3-month response at that point. There was a very big lever somewhere, and it got pulled mostly across the globe. Now, bearing in mind this big response is basically like a big wall of money being thrown at financial markets. Why did inflation fall again relatively suddenly? And it's largely because we went into this with big economic stimulus, record loosening. And we've come out of it with record tightening. We've had interest rates rising at a velocity that I've not seen in my career. Here you see the years following the financial crisis. The US in blue at least made some efforts to build their interest rates back up from where they were pre-financial crisis. The rest of us didn't really bother that much. And then COVID came along and just crashed all of those efforts and put the rates lower than where they'd been in the first place. So you can see that the response is a very steep one. We got used to monthly interest rate increases of 0.5, 0.75%, the same thing happening the next month and the next month. That's very rare. And you can see now that thankfully there's something of a plateau. Usually historically, after a plateau of interest rates, they don't tend to keep going up in the direction they were just going. We believe the direction will be downwards from here. The conversation is when rather than if. So, separating markets from geopolitics, it's fair to say that if you switch on the TV or look in a newspaper or online, the world looks a very scary place at the moment. There's war and a lot of discord in the world at the moment, and political backbiting, and so I've looked at this because we get asked about events that aren't strictly speaking economic or market related, but it's saying, well, how's this going to affect markets? And I've tried to separate things out into what I'd term primarily economic events, geopolitical events, and other. Now, Russia, Ukraine, and Gaza, Israel, they've actually been put in geopolitical, whereas you might think they're other, but a lot of armed conflict, in my view, is really a breakdown of politics. It's where politics has failed to resolve difference or conflict, and then it becomes armed. Now, I'm looking at this from the perspective of, we've seen that, we saw with Russia, Ukraine, that tilted stock markets for about a month before it was recognised that probably wouldn't drag NATO in and become a wider conflict. All it did is push inflation higher that was already a problem in the system. Gaza, Israel, markets panicked a little bit. They were uneasy for about 4 weeks and then reasserted themselves. So we're not in a position yet where we can say that these conflicts alone have actually impacted markets over the longer term. Whereas things like the response to COVID, well, that gave rise to inflation a couple of years later. That's a multi-year thing. Inflation, that will impact markets for a period of time. Interest rates, these are all economic stimuli that do have an impact on markets. They are things that we do concern ourselves with. Recession, soft landing, these are all things that will drive market returns. Things that have driven markets to an extent, global currencies, that's another one. You know, if we look at last year, for example, the Japanese stock market was at 28%. But if you're a sterling investor, the yen weakened significantly against sterling, you only got about half of that return because of currency effects. So global currencies have had more of an impact on market returns for how you're invested than, you know, North Korea trialing cruise missiles or even Trussonomics. And so the point I'm trying to get across here is that geopolitical events are important, but they're not always the big drivers of market returns, the end results in your portfolios. What they tend to do is they tend to become multi-year thematic things that we have to worry about later on, that may have impacts later on that we can't foresee now. And we can only allocate and we can only invest with things that we can see. The ones that are sort of in the orangey colour are things that are in between. They're things that are worthy of separate comment. So Russia-Ukraine I've commented on. That was something that affected global trade. COVID affected markets, but it's only because it provoked an economic response. Climate change is massive. That's massive to our industry. It's massive to investing. But it's one of these multi-year thematic things. One of the questions that we have been asked sort of relates to that. So that's something that will be covered in Q&A. But generally, the message I want to get through here is the last couple of years, despite all of the headlines that make us fear the world is ending, what the market has cared about has been mainly inflation and the response to it. So investing through the inflation bubble, this has been a really interesting time to be an investment manager, putting it politely. And if you're looking at the conventional investment wisdom for portfolio construction, if you're trying to invest to deal with inflation, what you really want to be investing in is real assets, things that tend to have a long-term track record of beating inflation. So you're going to have real assets, equities, property. Residential or commercial property, and gold. Gold is another inflation hedge, so that's another option. There are loads of options, but these are the main ones. And you tend to avoid assets that are nominal assets that will perform with or under inflation, so cash and bonds, government debt. You will tend to not invest in those if your aim is to beat inflation. On the other hand, whilst we were dealing with inflation, you could see that we were dealing with real market volatility. So if you're investing and only looking at market volatility, what do you invest in and what do you avoid? Well, you hold bonds and cash because they're lower volatility, but you reduce exposure to real assets because they're the ones that have got all the volatility. So you can see there's a mismatch here. And it's very difficult to satisfy both at the same time. So we can't defy gravity. We have to try and plot a course through the middle through that period. So how did we respond at portfolio level and in asset allocation terms? Well, to beat inflation or to combat inflation, we sold government debt. We were completely out of government debt by May last year, but we'd been reducing it from November 2022 as soon as we started to become more concerned about the effect of inflation. And as soon as inflation became something that wasn't going to be gone within a couple of months, and we weren't happy to sort of sit through that wave and invest through it. So later we were arguably more active in the number of changes we made, but essentially we tried to take the risk assets, which is equities, and just dial down the risk a bit. So we reduced small and mid-cap UK equity exposure, apologies, line interest, and we bought FTSE 100 because we saw at the beginning of 2022, we want oil and gas, we want exposure to the things. It's another form of hedging our bets, really. We sold it a year later, so we have no FTSE 100 holding in our portfolios now. We halved our exposure to emerging markets very fortuitously, timing-wise, and we bought global value equity. So again, we're looking to buy the cheaper, sort of more industrial type industries that had less far to fall in volatile times and were actually on the rise. And we added to cash and bonds. So you can see, bearing in mind where we should be invested, this was us walking a tightrope and compromising as far as possible. So the path to recovery, to bring us to an end really, this is UK inflation and interest rates. So you can see the inflation curve. And you can see where interest rates have risen to rise it, have risen to meet it. So interest rates currently sitting at 5.25. The big debate is, when are they going to fall? Not are they going to fall, is it going to be this year? It's Is it going to be April? Is it going to be March? Is it going to be July? Is it going to be August? And how many rate falls and how big are the rate falls? And we've got an election coming up. Are they going to get them out the way before the election? All of these questions. So the speculation is about when and how much, not if. And so a lot of the market volatility you're seeing is about that interest rate trajectory here and in the US. But what you're seeing here is just one way. It's just an upward staircase with interest rates. So if we look at the US, and the blue line again is the US inflation trajectory. They're slightly ahead of the curve with us. And so you can see a better illustration with their interest rates, where the dotted line is forward guidance really. You can see that interest rates do follow this inflation curve. And so to basically cap that off as to what we see as the path of recovery, this is a story that we're already most of the way through. We've dealt with pretty much all the uncomfortable parts of it. So we've seen inflation rise in late 2021, and we've seen interest rates rise to meet them in 2022. We've seen inflation peak. We believe now we've seen interest rate peaks. So this back and forth, we've done that. So late 2023, the important bit is this Fed pivot. The reason for the everything rally is that we've seen that market rally because we believe we're at that plateau now. And so 2024, it's more about interest rates falling, and then hopefully 2024 market recovery. Now I'm in danger of treading on Gavin's toes at this point, so I'm not going to go any further with that. But this path to recovery I see is like trying to get from Leicester to Manchester using the M6. You're going to get unexpected events and delays along the way, but it's not a question of if we're going to get there. We are going to get there. That was my presentation. Thank you very much.
Good morning, everyone. Thank you for coming back. Hopefully we're all refreshed. My presentation today, I'm going to be looking at three areas. I'm going to look at our portfolios and how they've actually performed. I'm going to look at our asset allocation and where we're investing at the moment. And then I'm going to finish off with the potential for the future and where we see things going. We know that over recent years we've had lots of headwinds to deal with, but what has their impact actually been on performance? So the chart here, if you can see it, it's our balanced risk portfolio. So we've used it as a proxy for returns. And we're looking at the last 5 years, and on the chart I've put with the green arrows those major headwinds that we've faced. So we can clearly see that at each one of these events, markets have reacted negatively. But on the positive side, they've recovered. So whilst it's not been a smooth journey over the last few years, we've still ended up with positive returns. Those blue squares indicate when we've made changes to portfolios, so that you can see that throughout all of these events, we've been actively managing the portfolios to try and get the best outcome that we can. So if we look at the performance in a wider detail, on the table here, we've got all of our discretionary portfolios. So we've got three risk categories: cautious, balanced, and adventurous. And we've compared the figures here over the last 3 calendar years and a 3 and 5 year period. We're showing the figures against our benchmark, which is the Investment Association Mixed Asset Sectors. And this is really important because these sectors are made up of our peer group. So this is all of the other wealth managers and managed funds that are investing on a similar basis to ourselves. We've colour-coded the returns, so you can see the colours there. Green's a bit washy, but the blue and green colours, that's first and second quartile performance. So it's pleasing to see that over the longer term, despite the volatility that we've had to contend with, relative to our peer groups, we've generated second quartile performance. So if we move on to our asset allocation, so where are we currently investing money? We're showing here the major asset classes, and we've got our 3 risk categories. So at the higher risk end, adventurous, we've got the highest exposure to equities, UK and global markets. As we come down the risk scale, the exposure to equities reduces in favour of fixed interest and what we class as alternatives. By this, we're talking about particular themes, so infrastructure, artificial intelligence, global insurance. And Simon made the point at the end of his presentation, Last year, we raised cash in portfolios. We've recently deployed some of that cash. We've brought it down to 4% and we've added to fixed interest. And that's largely driven around going back to interest rates. We think they've peaked. Fixed interest, we can lock into reasonable yields, but we're also looking for the capital upside as and when interest rates fall. We're still holding some cash. We're keeping it under review. We're looking at some particular themes in global equities that we might add to, but we're waiting for those opportunities to arise. So we move on to the potential. We know we've got headwinds. Simon's already covered some of these. We've got recession risk. Central banks, all of the rate rises that they've put through, they've tried to engineer a soft landing. It looks as though, certainly in the US, we've achieved the soft landing, but there's still a risk that that might deteriorate further. We've got central bank policy error. Now, central banks, they've gone through raising rates. The rate rises that we saw last year, it takes 12 to 18 months for those to wash through the cycle. So we've still got the potential that those rate rises cause us some discomfort. And then geopolitical. We know about Israel, we know about Gaza, Ukraine. We've got these big risks that we've got to contend with. Will they escalate further? And we know we've got a number of elections. We're mainly talking about the US and the UK in terms of elections, but those risks are there. But it's not all negative. We've got lots of positives to look at as well. We know we're going to get rate cuts. We don't know exactly when they'll start. At the beginning of the year, the markets were pricing in that the US would potentially cut in March. That's now been changed. But we know that these rate cuts will come through. GDP strength. Certainly last year, the US market was extremely resilient and outperformed all of its expectations. We've got the potential for that to happen again. And attractive valuations. We're really focusing on the UK here. We've heard all about it from Victoria and Anthony this morning. The UK market really is giving us some good opportunities. So I'll cover off some of these points in a bit more detail. This is quite a busy table, but just to highlight here, we're looking at a number of economists' forecasts for 2024. The diamonds are showing where we ended 2023, and the orange bars are showing the range of forecasts from different economists. So if we look at GDP on the left-hand side, again, going back to that soft landing environment, most economists think that we're heading for that soft landing. There is some potential to the upside, but hopefully there's a lot lower chance of us falling into recession. If we move on to inflation in the middle, again, this is more synchronized. The consensus view of economists is that inflation is going to keep falling from the levels that we're at the moment. The range there, I mean, in some instances, we're going back to central bank targets, but certainly close to them, which again is another positive. And then finally, on the right-hand side, unemployment. Again, the forecasts are that unemployment is going to tick up slightly this year. Interest rates. We've talked about interest rates all morning. This is purely focusing on the US market. So this is the Federal Reserve's expectations for interest rates over the next few years. The green line through the middle is the average Federal Reserve forecast. So if we're looking at 2024, we're looking at about 75 basis points of cuts expected. The blue and purple lines are the market forecasts. So the market is actually pricing in more rate cuts than what the Fed's anticipating. Now this chart was obviously end of December. The start to the year, we've seen some positive data. Some of those market forecasts on rates have moved slightly more towards the Federal Reserve. But the fact that we're getting rate cuts is just another positive support for both equity and bond markets. Elections. Now elections has been it's a big theme. We've had questions come through already about it. This chart is focusing on the UK market. The similar pattern will apply for the US market. The table is the annual returns of the FTSE All-Share Index over the last 38 years. Again, if we look at the individual years for the elections, markets have been volatile. We know that in the lead up to an election, there'll be some uncertainty. Markets will react to it, but then we'll see through it eventually. The real message here is that despite all of this volatility, trying to time a particular event is far riskier than just remaining invested, investing through the cycle and getting the benefit of those long-term compounding returns. The UK market. We've heard lots about it this morning. This chart is a slightly different take on one of Victoria's. It's the forward 12-month price to earnings ratio. We've got different categories, so we've got each different region and their PE ratio. The black line through the middle is the average. So we're looking currently that the UK market in the orange line is at a 20% discount to the global average. If we just look at the US market in isolation, we're over 40% discounted to the US. Now we know that's been driven by technology firms, the Magnificent Seven, the huge growth we've seen in that area. But the UK market, you know, we've got lots of factors. We've got M&A activity, we've got valuations. All of these are giving us, you know, a real opportunity to invest. And this is the main reason why, I mean, I can go back to the asset allocation. Our UK exposure is overweight. Compared to our benchmark, compared to our peers, we think the UK market offers some real value, hence we're overweight. So just summarising, I mean, this is where we, you know, prediction-wise, 2023 was a positive year, but during that year we had lots and lots of volatility. 2024, we think, is going to follow a similar pattern. We've got uncertainty of elections, we've got the geopolitical issues still in the background. That's going to create uncertainty for markets. The whole timing of interest rates, when are they going to be cut, is creating uncertainty. But we think as the year progresses and we start to see these interest rate cuts coming through, that will still deliver us positive returns over the year. We've had a huge shift in central bank policy. We've gone from zero rates, we've had a huge rise in rates, and now we know we've paused, we've peaked, rates are going to come down. Again, that's going to be supportive for both equity and bond markets. The headwinds, mentioned numerous times, we've got these risks, but they're known unknowns. We know they're there, we can try and react to them, but the key thing, all of this volatility, whether it's from you know, economics, whether it's from geopolitics, we think that the best way to navigate through this is diversification. So whether it's within our UK exposure, we've got exposure to large cap, we've got exposure to mid cap, we've got exposure to small cap. We're covering those bases. We've got exposure to different asset classes. So we've just added to fixed interest. We've got thematic funds. We're trying to make sure that we're covering all those bases and navigating through that path that Simon showed on one of his slides, where we're trying to react to what all these risks are. But we know over the longer term, it's going to be economic fundamentals that are going to drive returns, not short-term events such as elections. And the active management part, you know, we are actively managing the portfolios. We're looking at what's happening in the short term. We're making decisions on how to navigate that, but we're also looking at what our strategic positioning is. You know, how are we going to benefit over the next 3 years, 5 years, 10 years? So that active management is really key. We have got a Q&A session. We've got a number of questions from clients. We're going to open it up to the floor. So please, if anybody's got any questions, please feel free to ask. There is a compliance slide that our compliance manager will tell me off for if I don't show it. But
what's the mood? Okay. Brilliant, thank you. We'll start with the mood. The mood is reasonably upbeat, we would say. The performance of companies, the results that are coming out are generally in line with expectations. And certainly if you're coming out in line with expectations at the moment, the market's tending to take that quite positively, because there was a slight degree of caution quite a few months back, and people were worrying a little bit more about potential downgrades. So an inline statement is being greeted quite positively. You saw that with a company like Renishaw the other day, which is one of our precision manufacturers. They do amazing measurement precision manufacturing, and we hold those in special sits in the UK Growth Fund, but they came in line, and then the shares were up 16%. So generally things look quite positive. Where it's a little bit more difficult for companies is where there's still, breathe a sigh of COVID, is still a bit of a lurking issue for companies. Particularly where they had actually a really strong time during COVID. So, you know, a big business like Diageo, for example, had very strong demand, not only during the lockdown time, but then obviously when we were all released again as well. You know, they had strong demand coming through. And what they've seen more recently is some quieter activity in the US and some destocking in Latin America. We've seen companies like Spirax-Sarco that are has a division called Watson-Marlow, which does peristaltic pumps. So a lot of these pumps get sold into the pharmaceutical industry. And they had very strong demand during COVID, and now they're suffering a bit from destocking in that area. But outside of those sort of areas, and outside of areas which are really at the sort of discretionary end of demand, most companies are performing pretty well, they're meeting expectations, and they're reasonably upbeat about the year ahead.
Fantastic.
Yep.
Yeah. Thank you very much. Unless you've got anything else to add? No? Very good. Gavin has just spoken there about elections and highlighted elections this year. I think we've got 50 elections or so across the globe. 60. Notably for us, the ones that we focus on being the UK, the US. Perhaps one of you could expand a little bit about your forecast for the election this year and what the impact might be one way or the other.
Hi there, everybody. So I think the first thing to say, and hopefully it came across clearly in our presentation, is that we don't attempt to call those big macro events. I mean, I literally was nodding away when Gavin was talking about, you know, wanting to take the through cycle view and not getting bogged down and trying to time some of these things, which is inevitably very, very difficult, especially to do with any kind of consistency. So that very much chimes with how we think about managing the portfolio, very much fundamentals based, and sort of let the noise happen around you, because over the medium to longer term, that's how you generate the best returns. With that said, you know, obviously we're aware of the macro that's going on around us, and we need necessarily to be aware of it and factor it into more short-term sort of tweaks to the portfolio or how we think about our companies. But outside of, I mean, there are always individual businesses that might get impacted one way or another. I mean, that can happen either way. So a company like Kainos, for example, which is involved in providing digital services to government. You know, recently businesses in that space have been talking a little bit about a short-term hiatus in demand, just as we wait to see what happens. So there will inevitably be some of those. And likewise, there will be some on the other side. So you know, we're also invested in a business called YouGov, which many of you will have heard of from its polling activities. In reality, the polling is actually a small part of the business. It's really a market research provider, an increasingly data-led one. But of course, at the margin, a big year for elections is positive for a business that derives revenue from that activity. So outside of those couple either way, I think the main thing that we sort of get coming through from our management teams is really that, you know, certainty and the ability to make decisions, build your forecasting, run your business according to what you know is happening. So in that sense, I think the fact that we have two options which look like it's likely to be quite centrists, not too extreme either way, and the fact that when it happens, hopefully we can then all look forward to a little bit more political stability than what we've enjoyed over the last couple of years, will probably be positive for businesses and will be taken well, whichever side of the political equation wins out.
Thank you very much. Gavin, Simon, given what we've heard today from Lion Trust and some of the graphs we've had on the screen around the UK and it being good value and the opportunities, are we going to be adding more to the UK?
Give us money.
I think at this point, if I just flick back to our asset allocation, our UK exposure, we are, I would say, significantly overweight the UK. So compared to our peer groups, we know that we've got more UK exposure. So the decision for us is quite simple in the sense that we don't want to increase that overweight any further. But within that exposure there, I mean, if you just take our balanced portfolio, we've got about 27%, 28% in UK equities. Now, about 60% of that is split between mid-cap and small-cap. So we've nearly got a third of our UK exposure in UK smaller companies already. So we think that we're already well placed to benefit from any recovery at that sort of mid to small cap end of the market. So we're not actively looking at adding any more. We think we've got sufficient and we're well placed already.
I guess building on from that, a question from David Campbell was around the risks for 2024 and potentially not only with our UK exposure, but where do we necessarily see our asset allocation changing, adapting to those risks?
Start?
Yeah, fine.
I mean, risk-wise, last year we were nervous. Certainly mid-year we were nervous about all the volatility. We de-risked slightly, so we reduced some of our equity. We upped our cash weighting. Again, going through that, looking through the cycle thing, and Simon's point about how, markets bottomed when the fear factor was at its highest, and then markets recovered through that. We think we're at a point where we know we're going to get some choppiness over the next few months, but we want to make sure that we are invested, ready to take the benefit when markets recover. So, we've deployed some cash already, so that's gone to fixed interest because we know rates are going to fall. We want to be a beneficiary of that. We'll probably tweak the equity side, so we're looking at some global exposure at the moment. But we're already placed in that long-term beneficiary of equity markets. So we'll do some tactical changes around the edges, but largely that sort of makeup of the splits is I think, ready for what we've got coming down the line. Do you want to add anything? Phil?
Yeah, I think in terms of risks, if we were talking 1 or 2 years ago, it would be we would have been concerned about central bank policy missteps, that they would put interest rates up too high or too fast. Now it's probably fear of central bank policy missteps, that they keep them too high too long or don't reduce them enough. We're mindful that we've got elections coming up in the UK and US. We're not majorly concerned about UK election results, but it's this thing we've still yet to feel the real bite of interest rate changes to date. It takes a little bit of nimble footwork and a bit of wisdom in Bank of England to make sure that that's handled properly coming back the other way. So that's probably more of a risk than most of the other things that you'll see on the news headlines. That's my view.
Thank you very much. Question from Tim Bradley, quite topical I guess this morning given Labour's announcement. In our typical balanced portfolio, what portion have we currently got in fossil fuels, mining, etc. and over the next 10, 15 years as we transition towards a net zero, what's our strategy to move with the times?
Great question, Tim. If we look at our portfolios, bearing in mind that asset allocation there, you're going to get exposure to oil, energy, fossil fuels, miners. You'll get that more in your UK equity exposure than anything else because of the reasons that were in my presentation. That's where the large cap and the FTSE 100 is skewed to. But bearing in mind, UK equities is only a part of your portfolio, and within that, probably 40% of that UK equity exposure is large cap. It's not going to be huge exposure. If we break it down further, if you look at sectors of the UK stock market, the sort of stocks you're talking about are really split between 3 sectors, which is energy, utilities and basic materials. Basic materials being more your sort of miners and commodities. Now, we sort of invest across 7 different UK equity funds within portfolios. Not everybody has 7, but there's 7 that are in our stable of funds that we invest in. 4 of those avowedly don't invest in oil stocks at all currently. 3 of those is because they're more convinced they're not greatly run businesses and they don't want any part of them. 1 is more for environmental reasons, and that takes me sort of, if you think of fossil fuels, it's almost like we've largely come through an area of coal, and oil is the next on the list. And then you've got natural gas. Natural gas sits a bit more widely across portfolios. So the infrastructure investment talked about, that holds natural gas, and the reason that it does that is because it sees it as a transition energy. It's sort of weaning us off coal and onto the next thing, and it's the thing in the middle while everything else catches up. So yeah, if you look just at UK equity funds, depending on which fund you're looking at, you might be as much as 20% invested across those three sectors, but realistically, you know, Lion Trust, I think you've got about 0.6% invested in one of them. So it really is a mixture. It's not a major part of portfolios. You'll find it in when you're trying to generate yield, because these businesses, you know, BP, Shell, the energy companies, they generate a lot of dividend yield. So it's difficult to leave them out of some of those funds. But it's not an important area for us. However, the transition to sustainable and greener energy, renewables, that's a massive theme, and it's one, if we stood still and didn't do anything, the fund managers would sort of make that transition for us to an extent, because they're looking thematically all the time anyway. So we almost don't need to do anything. But it is an important theme, and you know, profitability will come through as technology develops in renewables, and also government subsidies, which used to be firmly in the fossil fuel camp, sort of move over to the greener energy camp. So it's an important thing. If you're investing with us in more ethical based portfolios, which we do have, where, you know, fossil fuels are deliberately screened out, so you won't find anything in there in terms of fossil fuels, then we already have a positive push towards sustainable energy there. So it's something we're mindful of, and, you know, over 10 to 15 years, I'm sure that's going to be an ongoing theme.
Okay, thank you. We'll open it to the floor. If anyone would like to put a hand at the back there, please, Alistair. Turning the mic on.
Hello.
Yep.
Hi. Great presentation, thank you very much. I haven't been an investor with Boolers for too long, but I've got a couple of questions. We were a late arrival, so forgive me if I missed something earlier this morning. You mentioned, I'm specifically interested in the UK, and you mentioned something earlier about the value of UK stocks and why they were worth investing in. You said something about a 20% discount. And the question that popped into my head immediately was, well, why are they 20% discounted? And the word I haven't heard mentioned at all this morning is Brexit. And I was wondering whether or not the reason they're discounted 20% is because the UK's situation now is arguably no better than average and probably getting worse because of the barriers to trade with mainland Europe. So I'm curious to know, and added to which, according to anything I've seen in the press and tried looking at, the UK economy has zero growth in it and very, very poor historic productivity. So I'm wondering whether or not I'd like to know in more detail what your philosophy about continuing to invest substantially, by the look of it, in the UK is actually based on. And just a prediction for since I'm standing up and got the microphone in my hand, that Joe Biden will win the US election, because in the end, American voters will choose their wallets over an orange nutcase.
Well, thank you for the electoral prediction. We'll certainly bear that in mind. In terms of the UK, yes, the UK market is a value judgment. You know, we'd have a similar value judgment as to why we favour Japan over, say, the US. We still allocate more to the US, but we're slightly underweight US, whereas we're overweight Japan, overweight UK. And it is that valuation thing. Really good question about, well, why? What did Brexit have to do with it? Look at our economic growth in the UK. Brexit does have something to do with it in that one of the reasons why we're a cheaper market is foreign direct investment in the UK. and that has fallen to almost historic lows in recent years. Brexit was a part of that. Is that unreasonable? Well, if you're a UK investor, if you're a UK investor investing in UK equities when Brexit happened, the stock market fell sort of when the result happened, and you would have lost in actual terms. But if you invested in US equities as a UK investor on the same day, if that market remained stable, the pound dropped about 20% against the dollar overnight. So you'd have seen an uplift on your overseas investments. Now put yourself the other way around. If you're an overseas investor, and even without the UK market moving, your currency suddenly was worth, your sterling-based investment as a dollar investor was suddenly worth less, you'd be pretty cheesed off with investing in the UK. So I think that did take a shine off foreign investors investing in the UK for a while. But like anything, if something becomes screaming good value, then we'd expect foreign investors to come back in. At the moment, one of the things that probably helps keep them out is political risk. We've had various changes of Prime Minister. It's one of the reasons we're probably not as concerned about the election result, because a party that has a perception historically of having safe pair of hands on the economy, that's probably called into question with all the changes of hands over recent years, and an incoming potential Labour government. The fear would traditionally be, well, they're going to borrow loads. Well, they've got fiscal rules in place supposedly that would prevent them from borrowing out of hand. So I believe that political risk in the UK is perhaps slightly overdone. Coming to you a bit about economic growth, I think we all too easily confuse politics with economies with markets, and they're three different things. That there's a relationship, certainly, but if you're investing in the FTSE 100 and 80% of your earnings are derived overseas, it's not really a proxy for the UK economy. And even in the small cap space where you've got more domestic exposure, as we've seen, there's, with Liontrust, there's over 50% exposure to overseas sales. So I don't think that weak growth in the UK economy, which actually is stronger than Germany's and is stronger than, if we look at the last few years, it's been up there with other G7 nations bar the US. I don't think the UK is as weak as we perceive it. But in any case, it's down to individual companies, which are basically individual profit centres. So I think the UK offers compelling value. And if you flip that on its head and look at, say, the US, if you look at the return on the MSCI World Index last year, 40% of that return came from just the top seven, the magnificent 7 stocks in the US. Well, is that sustainable year on year? Do you want to pay, coincidentally, 40% premium valuation for the US? Where's the real risk? I think it's more investing in an overvalued market that's already surprised on the upside. So I think the UK continues to offer compelling value, and arguably more at the small and mid-cap end, which is where we're overweight. I hope that answers your question. So,
Victoria, would you like to add anything to that?
Yeah, can do.
Yeah, I couldn't agree more with all of that, really. And one thing, I don't know whether or not you caught this part of our presentation, but we were talking about the mechanistic effect of outflows, persistent outflows from the UK equity sector, as being a reason for its underperformance in recent years. Now, that has been a really persistent trend, and as Anthony said in our presentation, it's been something that we and other members of the industry have been really actively lobbying for. We have been talking about specific policy catalysts, but it's more broadly than that. It's about reigniting our passion to support our own economy. As Anthony said, years and years ago, pension funds would have had really high allocations to UK equities. I heard Julia Hoggett, who's the CEO, Chief Executive of the London Stock Exchange, speak at an event recently, and she was talking about the importance of trying to get over to savers and to people who are saving into pensions, the fact that, of course, it is about making a return to secure your own retirement, but there's a broader piece there as well about ensuring that the legacy of the country we live in for our children and our grandchildren is also a vibrant, thriving economy. And it's our passionate belief that a healthy and thriving stock market is an important part of that, which is why we've been trying to actively lobby. Because if you think about it mechanistically, it does literally boil down on the stock market, particularly at the small end, to if there are more sellers than buyers, i.e. if funds are getting persistent outflows and don't have the available capital to deploy an opportunity, mechanistically that will force prices lower. And so we do think it matters. And again, as you've seen in our presentation, that whole...
Start on the M&A? Yep.
No, it is a big issue on a couple of levels. One is that private equity have been very successful at lobbying and better than sort of the listed company environment. So some of the tax benefits they get and the interest benefits they get, they've managed to keep in place. So they can sort of gear things up and they can get some quite effective tax benefits from the interest charge coming off. You look at something like Morrison's. When it was a listed business, it used to pay about £200 million in tax, and now it's owned by private equity. It pays nothing in tax. So these are definitely a problem, and there's a problem for the market as well in that there's lots of people who are less keen on being PLC directors, PLC boards, because there's greater governance strangulation on quite a lot of PLC companies. There's greater remuneration constraints, and people can make more money, they think, in private equity, or they can make more money listing their business in the US. So there's definitely got to be a fight back in terms of making it more attractive for companies to list. And maybe that's some reform in some of the governance angles that have perhaps been too strangulating. Maybe we've got to ease up a bit on remuneration and not be trying to screw people's pay down all the time. There's got to be a sense that it's a really attractive thing to do, to come and be a PLC. When I started work in the 90s, it was a really mark of kudos that you were coming and you were a listed company, and there were benefits from that in terms of your brand and your perception in the market. We've got to get that back somehow. There's perhaps got to be tax incentives for being a publicly listed company. Something that makes it more attractive for businesses to come. But it's really difficult. We've not seen enough IPOs. Private equity are taking businesses off us from the public markets. There's got to be something. There's got to be a better balance. There's got to be some incentives for people to be publicly listed companies.
Yeah, but just briefly picking up on that, one of the slides that Anthony had was that the M&A activity. So whilst we've got the negative side to it of private equity and sovereign wealth funds, we've also got the positive side to it. So the fact that we're holding funds that are investing in UK businesses, if the valuations are too low, then private equity will come in and buy them, but they're going to buy them at a premium. So again, that is a positive, I think.
Thank you. We'll just one more. We've got a question down here, Pepe. Yeah.
Thanks, Jake. I guess a question, perhaps Gavin, to you, maybe to you, Simon. You talked about the geopolitical impacts on the market, obviously Russia, Ukraine, and Simon, I think you mentioned that it was amber rated because you didn't see the likely involvement of NATO countries. In a week where that becomes potentially ever more likely, you mentioned, fortunately, prior to maybe the eve of the Russia-Ukraine invasion, there were some changes made, some divestment. Are there the similar levers that exist for Boolers? Are we exposed if NATO countries are involved, and would that consideration play out again? And I guess you're not given the grace of not trying to call big world events as an investment manager. Yeah. Do you want me to start?
Yeah, very good question. It's sort of geopolitical events that are more likely to keep us awake at night. I think with Russia-Ukraine specifically, we've noticed more sort of, I suppose, noise around sort of NATO countries warning us that we need to be ready, bringing conscription, fund defence far more, and you have to wonder why that is. Possibly one of the reasons is that they're trying to see off a Trump election victory whereby he drops Ukraine, and then it's Europe looking to support them. And what does that mean? Well, it means that a likely outcome might be they take more of Ukraine, and then there's a peace deal that Trump probably brokers, and then what's that mean? Russia's got a newly built military that can then take on the rest of Europe. Where these are sort of, they seem a bit fever dream-like to me, and it's also a good way for generals to talk of budgets. But we can't be overly relaxed about these things and complacent. However, the risks to us, we don't see that happening overnight. Our exposure, well, we dialed down emerging markets. That was more a general risk thing. It wasn't sort of Russia exposure directly. Thank goodness we didn't have any. But yeah, there's one factor. I think for us, it's not something that's going to happen sort of immediately, and common sense wise it makes even less sense than the invasion did in the first place, because GDP and military wise they just don't match up. It just makes no sense. So we don't see that as a likely outcome. However, we don't feel particularly exposed. It's just that markets are not going to be immune to this sort of thing. Far bigger issue is China, Taiwan, but I'm not even going to get into that. But that's a far bigger question, and again, we're relatively sanguine about that.
Yeah, I'd just add to that. The 2022, when all the tanks were lined up on this is the thing with the media. The media does a fantastic job for us in the sense that they hype things up so much that quite often the reality is a lot less than what you're seeing on the TV. But when we saw all those tanks lining up, we looked at our portfolios. We could see that Russia, by doing that, it would be ostracised. We looked at our portfolios. We looked at our emerging market funds. We had two. One of the funds had a higher exposure to Russia. We sold it straight away. Again, going on to risks. Currently, we've got some cash, not a lot, but we've just bought into gilts. So again, within that fixed interest exposure, we've got exposure to gilts, to government bonds, to corporate bonds. Now that rates have peaked and rates are expected to fall, we would expect that fixed interest element will naturally provide us that defence mechanism if markets do come off. I would then go back to, if markets do come off, we've got that long-term look through that we're trying to focus on. So even at 23rd of March 2020, the phone calls that we were having with clients, we couldn't guarantee when markets would go up, but we knew that they would go up eventually. It was just a matter of time. So the key thing is stay invested, benefit from it in the long term.